Hi everyone, it's Kaan Ristic from Beyond the Front Door, a relaxed, community-focused video series where we chat with local business owners about what it is that they do that makes their work meaningful and share local insights. And today we're here with Andrew Rahman from RJ Sanderson and Associates located in Epping. Andrew, welcome to the video series. Andrew is an accountant and there's a lot of information out there when it's tax time. But what I'd really love to ask you today is about capital gains tax. If you're an investor and you're selling a property, you may be liable for capital gains tax. If you can maybe just give us a few insights into capital gains tax.
Basically, what we found when we've dealt with clients in the past, when they sell their investment property, that they're eligible as long as they've held it for more than 12 months, a 50% discount. So that's a real eye-opener for some clients, and it's a very good value because in their mind they're thinking they have to pay tax on the whole net gain, but it's actually 50%. Okay. The other thing that also a lot of clients may not be aware is that because when they claim the depreciation on the property under tax legislation, when you sell investment property, that depreciation is added back as income. So they're realizing the benefit throughout the years that they've had the investment property, but once they sell it, they have to add it back as income. So that comes as a shock to some clients that in their mind, let's say they had a figure of $40,000. When we add back the depreciation, the actual tax payable might end up being $50,000, so $10,000 more.
And does it matter for capital gains tax what entity you buy the property under?
Yeah, so very important. So one thing we ask our clients is that what is their long-term plan and are they going to hold it for 20 years or short term? And also when we talk to our clients, asset protection is a very important element. So you've got clients in business, then we advise them to purchase any properties, whether it's commercial or residential, in the name of a trust. So, and the trustee will be a corporate trustee. The benefit there is that the other benefit of having in a trust, so let's say they hold it for the long term, then, and they want to pass it to the next generation, let's say they've held it for 30 years, then there's no capital gains tax. There is a small amount of stamp duty though, when they include adult children in the beneficiaries. It's about $300, $400, but basically to bring them on as beneficiaries, and then that property through the trust then passes to the next generation.
Well, it's valuable information, and I know that it's also dependent on the wage, the income as well. So that's something viewers can reach out to you more about because there's a lot more involved in CGT. If we could just talk a little bit about negative gearing.
When investors start out on the investment journey, initially the first investment will be in their personal names because to take advantage of negative gearing. But the problem herein lies that once that property becomes positively geared, meaning your income's more than enough to cover your expenses, they then pay tax at the marginal rate. So let's say, for example, someone's bought an investment property in their 30s, they're earning around $80,000. Marginal tax rate is 30%. Okay, hold it for the next 15 years. Obviously, their income has gone up, so they're now in the top marginal tax bracket. They're earning $200,000, where the tax bracket is 45%. So property is positively geared. So when they earn that net income, let's say 50% is held by the wife, who's the main income earner. Her income on that 50% shall be taxed at 45%. So whereas if you buy property in a trust, then the advantage is, especially a discretionary, we call it discretionary family trust, you have the advantage or the discretion, as the name of the trust suggests, have the discretion to distribute to various beneficiaries. So let's say, for example, the children have turned 18, so you can then, instead of distributing to mum and dad whose income is quite high, we distribute to the children instead.
Andrew, what about superannuation and utilising a self-managed super fund?
That's alternative way of investing is using your own using your own superannuation. So to do that, now I'm not a financial advisor, I'm just a tax accountant. When it comes to advising clients on the tax side of things, we advise clients, okay, look, with assistance from financial planner, if they don't want financial planning advice, we can still set up a self-managed super fund, and then our superannuation team roll over the fund into the self-managed super, and then the client goes invest in property. One thing we don't do, and we're not allowed to do actually, and no accountant for that matter is allowed to do, is basically source the property for the clients. Okay, all I tell the clients to do is make sure you do the research where you're going to buy. If you want to use the services of a buyer's agent or property advocate who can source the property. So our firm, we don't earn any commissions. It's a very bad practice, I believe. So what we tend to do is we ask the client if you know any buyer's agents or property advocates, get their advice, and then invest. And the biggest benefit of investing in a self-made super, and reason why people do it, because come retirement age and the clients retire, did you know that you may end up paying no tax at all? What that means is you need need to go seek advice from your accountant or come and see us.
Andrew, thank you so much for taking some time to share those valuable insights. And viewers out there, if you're looking for a great accountant in Epping and the northern suburbs, reach out to Andrew at RJ Sanderson & Co.